And Jeffrey Malaba, he's a global markets analyst, and we're looking at the global markets this week. A lot has happened, and of course, there's still focus on Europe. Europe policymakers are still battling to curb the debt crisis, and of course, Greece remains in focus. Also, Greek Prime Minister Mr. George Papandreou has been able to get a parliamentary approval to approve some of his austerity measures in exchange for bailout funds from the IMF and the EU worth about 110 billion euros. Good morning, Jeff. Thank you so much for joining us. Now, of course, as usual, a lot has happened at the global markets, but let's just stick to what the markets focused on this week. Of course, we haven't heard much from the U.S.'s President Obama, the U.S. Fed's Operation Twist, where the U.S. Fed said it will sell short-term bonds and use the proceeds to invest in longer-term securities. But let's start with Europe now. This debt debacle, as many investors or analysts have called it, is still going on now. There's a crucial vote today. German Parliament will vote on whether or not to extend or expand the Eurozone's facility fund from around 440 billion euros. But now we're seeing an opposition arising from within the German political caucus itself.
No, I think that the good news for the market basically this morning is that we know Merkel is basically full swing to ensuring that the EFSF bill is passed. However, the major opposition, surprisingly, have actually this morning are still in favor. You had the Greens and the Social Republicans are basically are supporting her. And from the markets, basically all analysts interviewed have given an okay that this bill will eventually be passed. That's why you saw the euro rallying, and you saw a return of risk appetite and gold shedding weight, because the market is pricing in a potential vote from the German players, basically, and then that will affect the other markets in the world. So we expect that to happen.
But I was looking at the numbers, reading out the numbers this morning at the global market. It seems like we're seeing a cautious trading because Asia ended down. The Hong Kong markets were closed. Europe is currently trending lower, and Wall Street ended lower yesterday. So one would think that that would mean that investors are just waiting on the sidelines to see just what direction or the outcome of this vote today before they dip their hands back into the markets.
The surprise play of the markets is this: the market players move contrarian to the thinking of everyone on the street. Now, what you're seeing happening right now is this: the pricing in the vote to be passed before now, and that's why you saw the euro coming down from euro has been down 11% against the yen. The yen is up about 4.5% against the euro, and that tells you where the euro is coming from a very slow support level. Now, as you see this rallying to the markets, what the market is saying right now is, apart from the fact that we've gone through this phase where this bill has been passed, what will happen to the markets? Any rally will be a short sell for most players who are syndicates traders. Basically, we call them syndicates. They think different from the crowd. That's why you see the market now. As you see this morning, numbers are almost shedding weight. Don't forget, about 3 a.m. Nigerian time, you have reports from Japan, which show the retail numbers were not so fantastic. Again, today, they're also looking at GDP from the U.S. These are key data. So the bill being passed right now from Germany might not have a longer-term influence on the market. Why is this so? If the EFSF bill is being passed, what will happen is that bonds can flow, monies can flow into markets that are ailing, which eventually will become good for the European Union. But the euro crisis is still a major crisis. Companies are basically suffering. Just this morning, Nokia has slashed over 3,500 of its workforce.
But Jeff, sorry to butt in here, but I thought this vote was very crucial because if the European Union is going to, or the Eurozone is going to increase this bailout fund from over 440 billion, that will mean that they will have more money to bail out a country like Greece or more. And so, of course, that should be a big step towards solving this debt crisis that has just gone on for so long. You
see, we've gone through this for a long time, basically, coming now. It's not the first time we're hearing about this. The Germans are the key players in the Eurozone. Second, you have the France. That's why you see Nicolas Sarkozy and, of course, Angela Merkel always looking at ways of saving, basically saving the entire region. However, there are still issues that are fundamental issues in the entire Eurozone. What we see on the news wires doesn't tell you the real picture as to how the market will play in the longer term. How do I mean? These are the worst case scenarios. First of all, you have the fact that apart from what we're seeing right now, the entire Eurozone is still having a major crisis on its hand. You have a potential default. Now, that means banks are not even giving money to banks. You saw the Fed now even giving out money away from his own core area, and then Republicans are also complaining against the Fed. Why would they give out loans to people who are not basically Americans? Because you're actually suffering the taxpayers more. So these are issues that we have to face. The Eurozone still has issues, and several companies are exposed to the European Union crisis. Even the US, you see, Barack Obama was complaining this morning that the crisis in the Eurozone, they have to really tackle it head on. Otherwise, it will affect the US market. So this bill is a sure necessity. It's not an option. It's a must that the Germans, because they are the biggest players, they are the big brothers of the entire Eurozone. You can't compare that to economy, basically what's going on in Italy, in Portugal, in Spain, and of course in Greece. Those are the alien brothers of the Eurozone. And those countries are basically dragging the Eurozone to a potential sovereign default. So that cannot happen. So this bill right now, we've seen the opportunities of this bill. It's like saying a stimulus package, which the IMF and the World Bank did for Greece. The same thing this bill is going to achieve. Because buying bonds of toxic countries is basically there's enough funds without going through the basic parties to pass those bills. So those funds will be there. If the funds are now passed to countries like Greece, Portugal, Ireland, Spain that are basically suffering, it means flows of funds into those countries. However, you must, who pays the piper dictates the tune. You must succumb basically to the dictates of the funders. That's how it is, and that's why Greece, you mentioned just this morning now that Greece is saying, look, we're going to go ahead and then, of course, play by the tune of the funders.
Now, speaking of Greece, they seem to be making some progress. Last week alone, Judge Papandreou was able to get approval from Parliament he cut government spending, reduced workers' wages and pensions. Of course, that didn't come without strike actions that we saw last week. And now, yesterday, he got approval also to increase property taxes. So it seems like he's at least trying to keep his own part of the bargain in exchange of the funds. And of course, don't forget also that international inspectors, the auditors, will arrive today in Athens to see just how whether or not Greece will qualify. So how do you see that playing out, tying that also to this fund?
It's good news. It's good news for the markets. We've said this beforehand that if Greece takes this loan, they must play by the tunes of the funders, basically, and they must put in austere measures. Because you have an entire country where even those who are learned refuse to pay taxes. From the lawyers to the doctors, to the accountants, they don't pay taxes. So this time around, you can't have your free lunch. There's no free lunch anywhere. So they must pay. Now, if this is going on right now, this is good news for the markets. How do you know it's good news? Look at what's happening to gold. Gold has been shedding weight. Gold tells you the thinking of investors who are solving, who are basically syndicates. Gold has shed weight to 1.60. As of this morning, it's gained about 10 basis points to the upside. That tells you that the market has priced in risk appetite. There's risk appetite on the street, but people are not seeing risk appetite because they're thinking that, look, we're going to see us achieve some risk aversion in the market. That's not going to happen. So basically, the markets might pick up steam. What you see players do right now, they're sitting on the fence. It doesn't tell you that they're thinking, basically. Sitting on the fence just means, hey, we're neutral on the market. We're not taking a decision right now. It's like driving a car and you approach a speed bump. You must put on your brake pedal. It's not to climb that bump at an easygoing pace. However, it doesn't mean you're going to engage on reverse of your gear. Will you do that? That's not likely going to happen. So that's what the markets basically are playing right now. They've seen that if Germans pass this bill, fine, that means funds will be on the streets. Funds can protect alien brothers of the Eurozone. However, there might not be any potential defaults anymore. That might give a return of risk appetite into the markets. We've seen crisis for the whole of this year. It's been one crisis after another. You saw gold hitting levels. In fact, yet till date, gold is still the superweight champion of all markets. Oh yeah, 28%.
Second to the
of course, the greenback. Gold has done 28% year to date, and it's still doing quite well. So investors now are watching. They're on the fence. They're watching what's going to happen to the markets, and then they'll go in again for a major key because we've said gold must still touch the 2.0 mark.
That's 2,000 mark.
Exactly. That's a psychological level. And for players who play markets, they must move prices to those kind of levels. To them, it boosts, of course, the market forecast and, of course, their own bottom lines as well.
Okay, so now for this German vote, you expect, you on your side, you expect that it will be passed.
It will be passed.
So what kind of figures are we looking at from 440 billion to what do you think they want to expand it to?
I'm looking at something a bit above 440 billion dollars to speak. But let's see how Europe basically. Let's see how it's going to go. First of all, the good news is this. Angela Merkel doesn't have any opposition right now. The Greens are in support. The Socials are basically also in support as well. So, which is good news for us, And that means the markets will price that in. The way these guys play markets is quite different from the way you and I think about markets. They look at it in the longer term perspective. They've gone into the market before even the votes were passed today. And that's what you saw.
So we've already seen, because I was going to ask you what the direct market impact would be, but you're saying now that the markets have already priced it in.
They've priced that in. In fact, this morning, a report from Singapore showed that what the syndicate traders are thinking about is this. If there's a rally on the euro, it gives an opportunity to sell. The banks don't want to buy high. The banks want to buy low, sell high. That's where you and I must think contrarian. We can't be like the heads. Or when in the chess game, you call them the pawns. The pawns always go first. The banks think different because once CNN reports it or you report it on channels, it doesn't mean that's when the market players will go into the market. They've already gone in advance. So that's when they're taking profits off the table. That's why they are syndicates.